Investing strategies for beginners. Investing can seem to be a difficult and frightening world, especially for beginners. However, with the correct knowledge and assistance, anyone may begin their road towards financial prosperity and security through investing. In this beginner's guide to investing, we'll go over the core principles and essential stages to help you comfortably manage the world of investments. Understand your financial goals. Before you begin investing, you must identify your goals in life. Are you saving money up for retirement, buying a home, or planning for your child's education? Defining your goals will help in the development of your investment strategy, plan, and risk tolerance. Educate yourself. Investing is risky, but knowledge is your best weapon. Take the time to learn about different investment options, asset classes, and market conditions. There are many materials available, such as books, online courses, and trustworthy financial websites. Understanding the fundamentals of stocks, bonds, mutual funds, and exchange-traded funds, ETFs, will set you up for success. Set a budget. Decide how much money you have ready to invest. It is important to create a budget that safeguards your necessary living costs or emergency savings. Begin modest and gradually increase your investment amount as you gain confidence and experience. Create an emergency fund. It's a good idea to create an emergency fund before getting into investments. This money should be able to cover at least 3 to 6 months of living expenses. It works as a safety net, ensuring that unexpected events don't push you to sell your investments early. Determine your risk tolerance. Investing involves different levels of risk. Assessing your risk level is important for choosing the best investment strategy. Conservative investors may prefer low-risk assets such as bonds, and aggressive investors may prefer high-risk investments such as stocks. It's important to find a balance that corresponds to your goals and risk tolerance. Diversify your portfolio. The saying that, "Don't put all your eggs in one basket," applies to investment. Diversification lowers risk by dividing assets among several asset classes, industries, and geographical locations. Consider a mix of stocks, bonds, real estate, and other assets to build a well-diversified portfolio that is able to tolerate market crashes. Choose the right investment accounts. Investigate the many types of investment accounts, such as individual retirement accounts, IRAs, 401ks, and brokerage accounts. Take advantage of tax-advantaged accounts, which provide advantages such as tax deductions or tax-free growth. Understanding the tax implications and account restrictions can have an important effect on your investment performance. Start with low-cost investments. It is best for beginners to start with low-cost investment alternatives. Look for low-cost index funds or exchange-traded funds, ETFs, that track a certain market index. When compared to carefully managed funds, these solutions often have lower costs, allowing you to keep more of your investment gains over time. Stay informed but avoid overreacting. Have a knowledge of market trends and economic news but avoid making quick choices based on short-term shifts. Investing is a long-term task, and market volatility is to be expected. Emotional reactions to market movements can frequently result in poor investment decisions. Maintain your long-term approach and focus on your financial objectives. Regularly review and rebalance. Review your investment portfolio on a regular basis to ensure that it is in line with your goals and risk tolerance. If necessary, rebalance your portfolio by selling or buying investments to preserve your desired asset allocation. Regular check-ins can help you stay on track and make the necessary changes. Thank you for watching this video. Please like, share, and subscribe.